to Series 3 of Women in Focus with Count Plus One. Today, I'm really excited to be introducing Siobhan Sada. She's one of our principals in the accounting, audit, and taxation space. And she'll sort of just walk you through what tax planning means and what the different structures actually identify and why they're key to key financial decisions. The first two webinars that we've had have focused on establishing what our influence is within our family group and even the wider network that we're in touch with. And then also looking at financial planning tools. We'll take it now a step further to actually look at some of the practical issues that we encounter with compliance. Siobhan, over to you.
Hi, thanks very much, Margaret. So guys, I might just wait a couple of minutes or a minute or so just to allow a couple of other people to connect from the attendee list. But thank you very much for joining us. I can see some regular people who have been on this webinar. And look, I hope to shed some light on tax planning and some tax structures that we commonly see. And hopefully this can give you, just a little bit of a seed to be planted to ask some further questions to see where your advisors can help you. Now, I'll just jump into what we hope to achieve from today. So we'll start with an overview of why tax planning is important. And this is for any stage in your financial life cycle. We then might jump into how or why tax planning should be a part of decision making. And then what we'll do is we'll jump into some case studies and some scenarios just to understand how effective tax planning can actually build your wealth in the short and in the long term. Now, I know I was trying to make this a 25-minute presentation with 5 minutes for questions and answers, but this is a topic that we see a lot of people try to move into as they are, moving through their financial life cycle. And so I might try to keep it to 20 minutes and allow a little bit of extra time for questions and answers. So there is a questions box just to the right of your screen. Please feel free to ask questions as we go on, and then we'll allow time at the end to go through those questions. And look, if we don't get to your question, rest assured we will get back to you within the coming days, just to make sure that you're around what we've just presented today. Now, before we start, there are a couple of things, obviously a general disclaimer here, but there are a couple of things that I just wanted to talk about before we, go into the into the tax planning realm. The first of those things is that I just want to point out that tax planning is always to work within the scope of the tax system. Tax planning will always assist with the best use of structures and measures within those tax systems. It does not at all evade the payment of tax, but it does ensure that there is tax effectiveness. Now, by tax effectiveness, we mean working within that system based on your goals to get you the desired outcome that you have. Another thing just before we start, I wanted to jump across to what we actually mean by tax planning. Now, essentially, this is just jargon that we use for the analysis of a financial situation, plan, or a goal, and forward planning to ensure that every element of that plan is working together to achieve the most effective tax outcome. So in this, we use different type of tax vehicles to allow that tax effective outcome. But again, tax planning will be very different for people depending on what your goals and your personal situation is. Now, just on some of those tax investment vehicles that we might be talking about, I've just highlighted here 3 of the most commonly used tax planning structures that we do use. And just to run through them very quickly before we go into any cases, we will look at trusts. And in this instance, we'll focus on discretionary trusts. Trusts give you the ability to, or discretionary trusts give you the ability to stream various categories of income to beneficiaries. Fixed trusts will park for the moment because they are probably the less common of the two. Discretionary trusts are also sometimes known as family trusts, and we can touch on that a little bit later. We then have your company structures that a lot of people will be familiar with. Now, these are separate legal entities that basically give you the ability to capture profits in a lower tax environment or a tax capped environment. We then have superannuation funds, which are the concessionally tax structures that you are in until such time as retirement. So a little bit later, we'll be going through 3 scenarios, but just up front, I wanted to give our focus to what the idea of this presentation is. And so realistically, what I'm hoping to gain from this presentation is just to plant a seed that there are various types of tax structures, and there are various combinations of these tax structures that we can put into place depending on your goals. But the result of that in the 3 scenarios that we're going to go through will show you the following. So in scenario 1, which we'll get to in a moment, we'll show that the next net tax payable would be around $28,000. In scenario 2, it'll be $20,000. And in scenario 3, we're going to show how the exact same set of facts in this structure would result in 0 tax payable. If I jump to what those 3 scenarios are, there are going to be some common facts that we use, and this will allow the ability for people to compare what these type of investments within these type of structures would result in. And we're going to use a 3-year period. So we don't want to just look at the short term, we want to look at the medium to long term for people, just so that you can really understand where we're coming from, why these structures could be so useful. So the common facts for these scenarios is that we're going to have managed investments, which would typically be shares in listed entities or units in listed trusts. We'll then have the income from those investments, and for example purpose, we're going to use the value of $45,000. And again, we'll assume that this is fully franked income. We then have a husband and wife, Homer and Marge. Homer is on a salary of $200,000. Marge is also on a salary of $200,000. However, she only works 3 days a week, so that will prorata down to $120,000. And they have residual cash between them after all their bills are paid of around $20,000. Now in scenario 1, which we'll jump to in just a moment, we're going to have these managed investments held in the personal joint names of Homer and Marge. In scenario 2, we'll look at what would it look like to have these investments held in a discretionary trust. In scenario 3, we'll then look at what these investments would look like if they are held in trust, but if the family group also had the use of what we consider a bucket company. Now, before we jump any further, I just want to point out that the concept of a bucket company is a company that we would see being used for the capturing of profits, for distributions or dividends being streamed to the shareholders of this company when they are in a more tax effective situation. Their most useful tax effective situation may be something such as retirement, or if somebody is going off on paternity or maternity leave, or there are various other mechanisms where this bucket company could be used. What I'll do now is jump straight into scenario 1. And scenario 1, as I said, the common facts are presented on the screen, but this is where the investments held are in their personal joint names. So 50-50 by both husband and wife. One thing that I just want to jump into before we get across to the summary of the tax payable over the 3 years for scenario 1, one assumption that we have used in this presentation is just to assume that the tax rates for the individuals year on year for the 3 years have remained constant. Now, we know that's not always the case, but for the purpose of the presentation, we thought that would be most useful. Before I jump into the detail of scenario 1 as well, you can now see on the screen, I guess, the income, the tax payable. There are quite detailed calculations that do sit behind everything that you can see on the screen here. And I'd be more than happy to share with anybody the calculations behind this so that you can get a better understanding of what actually goes into the calculation of the tax, as well as the application of the credits. And that works, for scenario 1, 2, and 3. So if we just look at scenario 1, we look at Homer and Marge with having the income of $232,000 and $152,000 respectively. Now, this income is made up of their employment income, as well as the income that they've been able to generate from those managed investments. Now, the tax on that taxable income would be just short of $83,000 for Homer and $47,000 for Marge. Now, they have some credits that they can apply, which consists of those franking credits we were talking about earlier, and that pay-as-you-go withholding that has happened from their employment income. So what we see here in scenario 1, where they hold this income in their joint names, is that there's net tax payable of around $6,000 for Homer and around $3,000 for Marge. Now, one thing I've chosen to present on this screen as well is the effective tax rates of both Homer and Marge. Now, the reason for doing this is to just show you that in a company structure, we all know that there's around 30% tax payable. What this effective tax rate is showing is that Homer in this situation has an effective tax rate of 36 and Marge of 31. What we're trying to represent here is that there is scope to move into other structures that would benefit both Homer and Marge. So over the next 3 years, with the investments being held in the personal name, what we see is a combined net tax payable of around $28,000. So if we just hold this amount in mind, what we'll do is jump straight into scenario 2. So with scenario 2, all the facts remain the same. The cost of managed investments and the income are all the same. Salary and wage income, as well as the residual cash, remains the same. The only difference here is that the managed investments are not held in the name of Homer and Marge. They're actually held in the name of their discretionary trust. What I'll do is now run you through the summary of the tax payable for this particular scenario and what that looks like over the next 3 years. So in this situation, we've got Homer with the income of $200,000, which he's gained from employment. The tax on his taxable income is roughly $67,000. Now he has credits for that equal value because his employer has withheld those throughout the year. So he has no additional tax payable when he lodges his tax return. Now, Marge will park for a moment and we'll just look very quickly at the trust. So the trust has that income of $45,000 plus the $19,000 that we were talking about as being franking credits. So the trust then has $64,000 to contribute to its beneficiaries. So we've then got Marge with the income of $120,000, which is substantially less than Homer. So what we've decided as the trustees of the trust would be to distribute that income across to Marge. Marge would then have a total taxable income of around $204,000. She would then have tax payable on that income of $59,500. The credits that she's been able to receive from the trust by way of franking credits is 19, and her tax withheld from her employer would see that she has a total credit of about $53,000. So the net tax payable position here would be that in one particular financial year is that Marge would owe about $6,500 when she lodges her tax return. So if we look at that on a 3-year period, the combined tax payable for Marge would be around $19,000, which compared to scenario 1 is an $8,500 saving over that 3-year period. So to take things one step further, we're now going to look at scenario 3. Now with scenario 3, once again, the investments are going to be held in the trust, but then the family group also has what we call a bucket company, which we touched on a little bit earlier. To run you through the summary of how the bucket company would work with the income being generated initially in the trust, first of all, we'll look at Homer and Marge. So Homer and Marge have their employment income of $200 and $120 respectively. They have tax payable of $67,000 and $34,000 respectively. But again, their employer has withheld those amounts. So when they lodge their tax returns, we can see that their net tax payable will be nil. We then have the trust once again generating income of $64,000. But rather than distributing this money to Homer and Marge, we've actually decided to distribute this money to the bucket company. The bucket company would then have tax payable of $19,000, which it then can apply its $19,000 worth of franking credits to offset that tax payable. So in this particular scenario, you can see that there is no net tax payable to any of the family group based on this current structure. What that means is over the next 3 years, if we kept consistent with the way that we wanted to stream this income, there would be a zero tax payable for the family group. Again, that would be about a $28,000 saving to that of scenario 1. Another thing that we just want to point out here is when that money has gone across to that company, we'll then have about $135,000 sitting in that company bank account. Now, we can utilize that cash in the years where the shareholders of the company are in a lower tax bracket. So again, just to touch on what I was saying a little bit earlier, those examples might be when somebody is in retirement or when Marge or Homer might go off on paternity or maternity leave, and we would expect that their employment income to drop quite substantially. Therefore, their effective tax rates would go beneath that of the 30% of the company. Another thing to consider when you've got investments sitting in different investment vehicles is capital gains. So I'll touch on this very quickly. I'm sure we've got some people here who are quite well versed in what it looks like to have investments, and whereas we probably have some people also that have joined today who are starting a little bit fresh and might not actually know what capital gains are. But essentially, capital gains are going to be the difference between the sale price of an asset less the purchase price of an asset. So what I've done here is just run, again, the same scenarios and making an assumption that in year 3, that either the personal investors or the trustees of the trust have decided that they will sell these shares or managed investments. You might remember that the common fact in the scenarios we were given were that the shares were purchased or the managed investments had a cost of $300,000. What we're assuming here is that they were then sold for $350,000, which would then assume a $50,000 capital gain. What I'm showing you here on the screen is the total group net tax payable in each of these scenarios, but only for year 3. So what we'd find in scenario 1 is if these shares were held in the personal joint names, we would see a tax payable of around $22,000. In scenario 2, where we have a trust, we would see a tax payable of around $18,000. And in scenario 3, where we have the use of the trust as well as the bucket company, we would have just shy of $10,000 tax payable. So what I'm hoping to represent here is that, yes, not only is the income generated year on year better in a tax structure that's been, well thought through, but also when those managed investments or other investments are sold in any of these structures, there are ways that we can distribute that income to keep the group tax payable down. And in this case, it would be around $12,000. Now, the next thing I want to run you guys through is just jumping back to the year on year. And again, the net tax payables we're now looking at exclude that capital gain. But I just want to look at what the compliance costs actually look like. Now, I'm actually quite proud and excited to share this slide with people because I think it's not often the opportunity we get to present to people what our costs can sometimes give you a benefit of in your, total group with the tax, the taxes that we can save for you. What I've tried to represent here is the net tax payables that people would expect based on the scenarios we've just run through, and then what the compliance costs actually look like if we were to set these structures up and the ongoing costs year on year. So again, the net tax payables look at the 3-year period. The compliance costs also do the same. So in scenario 1, we generally see a cash outlay of around $31,000. Scenario 2, around $25,000, and in scenario 3, around $9,000. Now, of course, these compliance costs can change. I've tried to use a median of what we could usually see with our client base. Again, they go up and down depending on which tax structures we actually go into. But I hope what this can represent is that sometimes the costs of actually putting these structures into place can still be a benefit to the overall tax saving or cash saving that you might see in being in one of these structures. Now, with that cash saving that we're talking about, I think it is important to say, well, what could your tax plan be then for that extra cash? And I think this is where we really do see the benefit of our tax team working well with our wealth or financial management team when these opportunities present themselves. Now, there are various things dependent on your goals or dependent on your priorities that you might be thinking about to do with this extra cash. Some things might be to do with your super contributions. Some things might be dealing with holidays, or you might have children or grandchildren that you might be thinking you could give this cash to. Now, dependent on those goals will depend on our recommendations of where that money goes. just before I jump into what things might look like in a different tax environment and where that money might go, I just want to touch on what we've been looking at in our previous focus sessions on age. And you might remember from the previous sessions that we've looked at various stages of people's lives, and we've looked at it in terms of age brackets. But what I want to point out here is that the concepts of any of these structures do not change. Our recommendations based on your plan and based on your goals will depend on then the recommendations we'll make for which investment vehicles would work best for you. And then obviously dependent on that is where our recommendations on where that cash should go. Now I've touched on the trust and company structure, but the other common structure, which I mentioned a little bit earlier on, was superannuation funds. And just on the onset, before I jump into the next slides, I did want to point out that when we are talking about superannuation funds, we are not always talking about self-managed super funds. Once again, that would be a recommendation based on your personal circumstance, and our wealth management team can walk you through that a little bit later. We're also talking about people who have money sitting in their retail funds, which is more common what we see for our people. Now, rather than present my own slides, I've actually decided to show you a couple of slides which are a refresh from last session, which Adam, one of our principals in the wealth management team, took us through some scenarios of how putting additional money into your super, so that extra cash that we're talking about, going into your superannuation fund may actually provide some longevity for that super when you are in retirement. Now, I've summarized these pages a little bit just to, with understanding that time is not on our side with this presentation, but jumping straight into the scenario that Adam put together for us. Once again, we've got Homer and Marge. Now, they seem to have taken a little bit of a pay cut from my last scenarios, but we'll draw that down to COVID. But look, we've got Homer and Marge with the income of $150,000 and $60,000 respectively. Homer has $350,000 in his super and Marge $150,000. Now, we'll assume for the presentation that they're going to work for another 10 years, just putting in their compulsory super from employment. The outcomes of this scenario is that the super balances would reach roughly $1.6 million at retirement. The super for Homer will run out when he's 90 and Marge when she's 85. Now, ideally, clients would like their money to last longer than this. So what we've done is then put into effect the new scenario, where they've got a little bit of additional cash based on the scenarios that we've presented a bit earlier. So we'll show here that Marge and Homer, same facts as before, same salaries, but what they do is maximize their pre-tax contributions up to the $25,000 cap. They then use the surplus cash flow that they have, and they put that money into super in an after-tax environment. This again is still concessionally taxed. We then have the outcomes that their super balances reach 1.78 million, which is, quite substantial on what it was previously. They then see that their super runs out at 99 for Homer and 94 for Marge. What we're trying to represent in this slide is that the longevity of the super savings has increased by 9 years. So essentially, they're able to fund their retirement for additional 9 years by putting into effect some mechanisms to get money into super with the extra tax that they do have. Now, I know we've run through a lot through this presentation, and realistically, I hope that we've been able to plant a seed to say there are reasons we put these tax structures into place, but your goals might conflict with one another of where to use that extra cash. So it's particularly important to prioritize. Some areas that we see people come to us, or we would strongly recommend people come to us before going into any type of structure, don't just fall back on the default of getting things into your personal name. We want to talk to you when you've got an asset purchase or disposal, whether that's your home, your investment property, managed investments. We want to talk to you when you're choosing to enter or exit into a business. We want to know if there's been a birth, death, marriage, divorce, an injury within the family. If you're looking to go into retirement, any education costs for your children or grandchildren, or you might have other short to medium term goals that we haven't represented in the above. We want to talk to you then. So just summing over, and I'll just pause here for a moment. We want to go over the summary of what's happened today. And then I know I've just jumped over to the 25 minutes of the presentation, and then I'll give you a moment to just pop some questions into the question box, and then I'd be more than happy to answer any of the questions that you've got. And please remember to reach out to us, and we can go through any of the questions that you might have a little bit later on.
Hi, Siobhan. Excellent. Thank you. Thank you. There are a few questions that are popping up, which I'll sort of just walk through. I don't think we'll get a chance to get to all of them, but please pop them through and we'll reach out to you to make sure that we do answer them individually. One of the questions that's come up is, you've talked us through these different scenarios and especially around the trust element. How do you actually go about setting up a trust?
Okay, so your accountant can certainly set up a trust for you. I think the main thing to point out here is please do not do it yourself. We want to make sure that it is the right structure for you to begin with. Essentially, the way that setting up a trust would work is it is a legal document, and we have people that we work with to put these in place. But I guess what we're essentially doing when we're setting up a trust is forming a deed, and therefore we need to know from you who the beneficiaries are, who are the people that we are going to be working with within these structures. So the first step would be talk to an advisor, make sure that it is the right structure for you, and then your advisor can talk with people within their network to ensure that the deed and other measures are set up to ensure that later down the track, you're not falling into any traps for setting things up that aren't exactly against, or aren't exactly working with your goals.
Okay, and you touched on some significant tax savings, but it does seem a bit complicated. So what is the process that you actually go through with clients to sort of get them to a point where they start to understand this and it becomes, a part of their long-term plan?
Yeah, so I think that the first thing for us is always to establish a goal. And I think we've been saying this throughout our focus sessions here, is that it's always really important to have a goal. The next step would be to come and have a chat. What we would then do is work out, what your current situation is. So we'd look at your current situation, we'd understand where you want to get, we want to understand what your employment income looks like, and we want to understand the larger family group. From that point, we would then go down the route of trying to explore what that, I guess, as a cash flow as well as a tax scenario would look like for you. We'd present options, and then of course it's always up to the client to choose which option they want to go with, and then from that point we would implement the structures. So we really need to understand from the client what it is that they're trying to achieve. Then we speak them through the realm of possibility, and then we can implement from that point on.
Okay, so how does it work? Because you're talking tax, but you're also, it sounds like you're talking about long-term plan overall.
Yeah, and they do work hand in hand. So, and that's why we have a particular focus, Account Plus One, of working quite closely with our wealth management team. We always like to look at things essentially hand in hand, because you might be able to get a tax saving today, but then in 2 or 3 years' time, it's not actually getting you to where your goal is. Now, people's circumstances change, and because of that, we need to be quite flexible in the structures that we put people into. But it's realistically looking and saying, okay, you have these goals for your family and your life. You have this current scenario with your employment and potentially residual cash, or you might have an inheritance that is coming up, as an example. Now, these things will then structure what we do from a tax effectiveness point of view, but will then also determine where your money is best placed in the long term to ensure that longevity that we were talking about a little bit earlier.
Okay, yeah. And I guess it's quite a personal thing, and circumstances do vary from person to person. Siobhan, thank you very much. I think we've got about a minute to go.
Sure.
So just to sum up the journey we've taken so far, we've talked about our spheres of influence, and those are the people that are in our lives and that we touch, and we actually we're trying to do things for. We don't wake up every morning without that in mind. We've talked about planning from a wealth point of view, and now we've just talked about planning from a tax point of view. So I guess it's about bringing it all together. Everyone's circumstances are different, so you should reach out and just ask the question, and we'll guide you in the right direction. If it's not us, make sure you're talking to whoever your advisor is. Reach out to us via our Women in Focus email address, and we're more than happy to answer any questions. We're on LinkedIn as well, so please just follow that through, and we'll keep you informed about things that are happening constantly. Our next session adds on to what Siobhan talked about today. Once you've got the tax plan in place, you've got the financial plan in place, and it fits within your life, what happens when life gets in the way? How can you actually plan for that? So please join us next month for that session, so we can just take the conversation one step further. Thank you.
Thanks, everyone.
Thank you.